What's up, YouTube? It's the Action Figure Grader coming back to you with another video. I've got some more recent economic data that's trickled out over the last week or so that I wanted to talk about, and how it indicates that there's further proof that the economy is eroding, both within the US as well as globally, due to a number of different factors. And I think that everything that we're seeing supports that idea. And I think things are going to get worse, unfortunately, before they get better. I hope I'm wrong, but I would love to hear your thoughts on this video. And before I dig in any further, I want to say thank you to my latest Patreon supporter, David Burkholder. He just became a Patreon supporter. I really appreciate the channel support from all of my patrons. If you're interested in becoming a Patreon supporter, it's patreon.com/actionfiguregrader. But anyway, as we dig into some of these recession indicators, I'd love to hear your thoughts as to what you're seeing and whether you think collectibles, specifically, like the stuff behind me, will start seeing price declines. So far, it hasn't really happened yet. Prices, for the most part, are relatively stable. But I think it's early, and I think that this fall, especially, we're going to start seeing that kind of decline in collectibles. And I hope I'm wrong, but it just seems like the writing's on the wall that the economy's not doing as well as it has been. And I think that more and more people are going to start selling off their collections to help pay for everyday living, be it groceries or, just living expenses, fuel costs, things like that. But let's go ahead and dig in. The first one I wanted to talk about is inflation. And of course, we know what inflation's been doing here lately, but Wednesday of last week, July 13th, inflation rose 9.1% in June, which is even more than expected. And it's pretty crazy. That number is massive. That's the biggest number we've seen since 1981. So in 40 plus years, that's the biggest monthly increase. And excluding food and energy, the core CPI rose 5.9%, which is still higher than the estimate of 5.7%. Gasoline, groceries, rent, dental care was mentioned as all items that have really jumped up. Adjusted for inflation, workers' hourly wages fell by 1% during the month and are now down 3.6% from a year ago. That's big, because what does that mean? That means that people are taking home less money, even though the price of goods is increasing. And that's a scary thought. And so, what's going to happen moving forward? Is inflation still being viewed as something that's transitory? I don't think so anymore. I think more and more people are waking up to the idea and waking up to what I was talking about in previous videos, that inflation is entrenched in the economy. And we're going to talk more about that in a second. But the other big piece of data that came out was on Friday, July 15th. Retail sales rose more than expected in June as consumers remain resilient despite inflation. So you read that headline and it sounds so good, right? That people are still spending despite higher inflation. And the markets rose, they went up like crazy on Friday. And I would say that, to me, any kind of signs of life in the stock market, in my opinion, is what I call a dead cat bounce, that the market is looking for any excuse to go higher, but they're not factoring in that inflation is here to stay for a while, and that we're going to start seeing this inflation stick around, and it's sticky, and it hasn't gone anywhere. The big number to look at is after adjusting for inflation. The retail sales numbers that come out every month, they are not adjusted for inflation, which makes zero sense to look at that data with any kind of to view that number as meaningful. And you have to adjust it for inflation especially when you're in a high inflation environment. But once you adjust it for inflation, retail sales rose 1.3% on a monthly basis, which is actually slightly negative. So what does that mean? That means that consumers are starting to pull back on their spending because everything is getting more expensive. They're digging into their savings accounts to help pay for groceries, higher rent costs, and gasoline costs. And it's going to be interesting to see, as inflation, in my mind, sticks around, how does that translate to retail sales, especially as we move into the fall. And I think, personally, what's going to happen is that people are going to pull back even further on their spending, especially discretionary spending, like restaurants, live events, travel. And we're going to it's going to help pull the economy even further into a recessionary environment. So keep that in mind when you see retail sales numbers get released each month, is that they're not adjusted for inflation. The more important number is after adjusting for inflation, in which case the number was actually down. And August 28th, we also get GDP numbers for the second quarter. Again, that's a backwards looking number. That's looking at April 1st through June 30th. But I expect that GDP number to be negative, which would be 2 consecutive quarters of negative GDP growth, which is the technical definition for a recession. So we'll see if that happens or not, but it does seem that way. Here's what's interesting is that, I talked about the Fed. This is June of last year when I talked about this, and I said the Fed is not acting quickly enough to stave off inflation, and they're going to be in for a bumpy ride. All of us are going to be in for a bumpy ride. And if you look at the inflation sticker shock, June consumer prices, gasoline versus last June of 2021, when I made that original video, gasoline's up 60% in price. Food is up 10%. Shelter, housing costs are up 5.6%, which I think is actually low. I think it's much higher than that. And so now the Fed, even though they just raised rates by 0.75%, there's talk now that they might raise rates by 1%, which has not happened in a very, very long time, if ever, when these numbers were starting to get pegged by the Fed to help stave off inflation. So, I think it's interesting that stocks in general are shrugging off shrugging off in inflation numbers, and it's almost like they're looking for any excuse to go higher. And part of that is because the monetary supply is so high right now. The monetary supply has tripled over the last 2 years because of a number of factors: lockdowns, stimulus payments, everything else. But when you combine that with a shutdown of production, it leads to low supply and higher demand, and as a result, we got the inflation numbers that we've got. So, but the Fed has indicated everything is in play. The Atlanta Federal Reserve Bank President Raphael Bostic said, and what that means is that the markets, he says the markets would have a heart attack, is what the Fed Governor Christopher Waller said last month. Well, I don't think that they're going to have a heart attack now. I think that it's very, very possible that we do see a 1% increase in the federal funds rate later this month. And maybe that doesn't happen, but it just seems like a very high likelihood number. And, the other interesting thing is that the Goldman Sachs, who just came out with earnings today on July 18th, they crushed numbers and everyone's really happy about it. Well, what are they doing? All they're doing is playing the interest rate spreads on their bond trading desk. And he says that inflation is deeply entrenched in the global economy. This came out today, July 18th. And so that goes against what a lot of the press that we're seeing over the last month or so, that economists and everybody else expect inflation to kind of taper off towards the end of this year. The Goldman Sachs CEO, David Solomon, says, no, that's not the case. That based on all the conversations, and here's the exact quote, "My dialogue with CEOs operating big global businesses, they continue to see persistent inflation in their supply chains. Our economists, meanwhile, say there are signs that inflation will move lower in the second half of the year. The answer is uncertain, and we will all be watching it very closely." Well, no kidding. We all are right now. So there's still mixed kind of feelings as to whether inflation is going to stick around. Me personally, I think inflation is going to stick around because the supply chain is so messed up right now. Not only because of what's happening in Europe with the Ukraine, but also what's happening in China. And China, as you know, has very strict COVID rules. And anytime they start seeing an outbreak, they extend lockdowns. And that shuts down factories. That shuts down production. What is China known for? China is known for producing a lot of the raw materials that go into the final goods and services that we consume here in the U.S. And we're going to look at the global economy at the very end of this video so you can see how large China's economy is, as well as the U.S. economy as a percentage of the entire global economy. And as long as China continues to have any kind of lockdowns Shanghai or other cities where there are large manufacturing bases, it's going to continue to have effects for the supply chain. And when you have supply chain issues and the inability to get these materials over here to go into those final costs of, the final production, be it electronics, appliances, everything else, it continues to create pricing problems. And so, whether this is short term or long term, who knows? But they continue to have infections and their response is a lot different than the U.S. Right? The U.S. it's kind of like isolate on your own, and it shouldn't shut down the economy again. I think we've all learned that it definitely caused a lot of major economic problems. China said they have a zero tolerance policy, and it really greatly affects the raw materials and everything else that they produce, ship over here for components in goods like I mentioned, cars and laptops, computers, any kind of appliances, things like that. So I just think that's a supply chain issue that we continue to see has an effect, and it's one of the major causes of the inflation numbers that we're seeing. So now let's take a look at the biggest thing that U.S. consumers purchase, and that's a home. And we've already seen that interest rates have had a major effect on 30-year mortgages. 30-year mortgages have gone from 3% to now they're in the 6s. I would wager that by this time next year, we might see 10% mortgage rates for 30-year mortgages, which it hasn't happened in a long time. And if you look at what the builder sentiment information that just came out today, home builder sentiment plunges in July as buyers pull back. So buyers are already pulling back on new home purchases, and the builder sentiment dropped 12 points to 55 on their index. That's the largest single month drop in the survey's 37-year history, with the exception of April 2020, which is kind of an outlier. And I think you can take that out of there. So that to me that shows that U.S. consumers, on the biggest item that most U.S. consumers buy during their lifetime, a home, they're pulling back. Resale homes have dropped off the face of the earth, at least for me locally. And it just seems like as the housing market goes, everything else trickles down behind it. So that's just an interesting data point that we just came out with today that shows that it's the largest drop in the 37-year history of this index, and it's just unbelievable. Now, what about copper? Copper is an interesting component. It's a raw material, and the copper market is usually a pretty good judge of what the economy is doing. If copper is doing well, it means that copper goes into a lot of different things, and if copper is doing well, it usually means that the economy is doing well. A major component in electronics and motors, it's often used as a bellwether of the economic well-being, both within the U.S. as well as globally. Well, guess what? That commodity fell to a new low. And what's interesting is it's the largest one-week percentage decline since late March of 2020, which again is an outlier because most economies were shut down during that time period. The metal has fallen about 35% over the past 4 months. And year-to-date, copper is down about 28%. So copper officially entered a bear market at the end of June. And what's interesting is anytime that copper, the raw material copper, has entered a bear market, it precedes each and every recession over the last 30 years. Every single time. 100% of the time. Anytime that copper has dropped into a bear market, we've had a recession very shortly thereafter. So we talked about the inverted yield curve that has happened a couple of times this year already, and how almost all the time when you have an inverted yield curve, a recession usually follows after that. Well, that's between 80 and 85% of the time based on the charts that I was looking at. With copper, it's 100% of the time. So now we've got a negative copper market. And so that just shows you that, while there are supply chain issues that are causing high inflation, copper's dropping like a rock because consumer demand is starting to drop. And copper is a big component in houses as well. Not only like electronics and things like that, but, a new home or new electronics, new laptops, new computers, TVs, all that stuff. Those are discretionary items. Those are not needed items. And people are going to pull back on that stuff versus must-have items like fuel to get to and from work, and housing costs and grocery costs, things like that. So as those things become more expensive, and those are necessities, discretionary items such as what we just talked about, appliances and things like that, those are going to drop. And I think it's only going to get worse. I think it's only going to get worse, and we're just at the very beginning of that. But I do think that that's a really interesting statistic. The other interesting thing is, again, this thing is talking about how the Fed might go for a 100 basis point rate hike. And they're saying that Wall Street is now penciling in only a 30% chance of a 1% interest rate hike at the end of this month. The Fed meets on July 26th and 27th. So what does that tell you? To me, a 1% rate hike is a lot more likely than 30% right now. But the market, at least right now, is only penciling in a 30% chance of that happening. And those guys know more than I do. I'm not trying to say I know more than they do. But it does make you wonder whether stocks have not seen their bottom yet. And I personally don't think they have. I think that the stock market in general, I'm talking in broad generalizations now, we could see another 10 to 15% drop before we start seeing a near-term bottom in stock market indices. So just some really interesting data in this. And again, for all this kind of stuff I'm talking about, I will include a link in the video description for those of you that actually like this stuff and want to take a look at it. Now, what's the other thing that we've talked about in past videos is how the labor market is so strong despite all of these negative things that we're talking about, despite high inflation, despite signs that consumer demand is starting to drop outside of core living stuff like food and housing expenses. The labor market remains strong. And an interesting article that just came out today is that the Microsoft's president sees a new era of a stagnating labor pool. And since 1950, the trend was that 5 million people enter the workforce every 5 years. And that's been kind of the general number. From 1950 to about 2016, every 5 years, another 5 million people entered the U.S. workforce. He's saying that from 2016 and on, that growth number is not correct anymore. Now it's more like 2 million. And so that's really telling, because that means that people are not willing to work at the current wages, and they're holding out for higher offers. And so to me, it could signify that the unemployment rate, quote unquote unemployment rate, that everyone says is so low right now, it's really not that low. It's kind of deceiving. And that there are people sitting on the sidelines that are either underemployed or they're not actively seeking employment. So you have to take that unemployment number with a grain of salt, because he's saying that people are sitting on the sidelines right now and waiting, and the government stimulus checks that we saw over the last year and a half or so has allowed people to do that. And the question is going to be, okay, is that $2 million people number the correct number now versus the 5 million number that has been historically the average for every 5 years? Who knows? But I do think that there is concern that the labor market is going to be the next shoe to drop, because as corporations try to fill out and build new stuff, if they have to pay higher labor costs, that has to filter down into the cost of goods sold. And that it kind of creates a self-fulfilling prophecy, so to speak, or a constant cycle of higher and higher inflation, and goes against the idea that inflation is transitory and that it could be. So that's that information. Take for it what you will. But finally, I wanted to finish off with this. This was a cool graphic that I found on the web, and it looks at the $100 trillion world economy. This is all very rough numbers, but it's estimated that the world economy right now is worth about $104 trillion. And you can see very clearly that China and the US make up the vast majority of that. They make up, well, not the majority, but they make up 45 trillion of the 100 trillion market. And as I talked about previously at the, about halfway through the video, if Shanghai is closing down or China is enforcing lockdowns, that's a big number. That's going to decrease because their factories are shutting down and they're helping reinforce the supply chain issues that we are seeing here in the U.S. And when they account for that big of a number, it will have an effect on us, and vice versa for us. As the U.S. Kind of enters this next stage of a recession, it has an effect on the rest of the world just because of the massive economy that the U.S. is. So these are not independent entities, right? The world economy is so intertwined these days and so global that as the U.S. and China go, and to a certain extent Europe, and we all know what's happening in Europe right now. The European markets are such a mess right now because of what's happening in the Ukraine, that when you factor in those big three, it's really, really eye-opening as to what's going to happen. Anyway, that's all I really had for this video. I just thought it was kind of important to show you some more recent economic data. And I just think that the market hasn't quite priced in that inflation of this 9% growth that we're seeing on a monthly basis. If that sticks around through this fall, you're going to start seeing some pretty eye-opening demand numbers for U.S. consumers and how that's going to drop pretty dramatically. So that's all I really had. Thanks so much for watching, and I'll be back soon.